So you guys could get to 2 million in revenue with very little operational lift just by finding one of those a year over the next couple of years, right?
What's going on, everybody? Welcome into the Highlight, of Business Podcast for business people. And today I'm excited to have a new friend on the show, but a guy I've been following for a long time, Matt Bodnar, the founding partner. I'm not going to mess this up, Matt. Eidolon
There
Capital.
you go.
I nailed it, right? And so you and I were talking a little bit right before we started off here. I'd love for you to give a little background on you and then Eidolon in general. Like, what is that? What does that mean? And why did you pick that name?
Chandler, thank you so much for having me on the show. Quick bio on me. I'm from Nashville, Tennessee, grew up in Nashville. I worked at Goldman Sachs up in New York for a number of years out of college. Came back to Nashville in 2011 and really kind of did two things. So one, I got involved with my family, which does a bunch of stuff in the restaurant and hospitality world. And they have a company called Fresh Hospitality that has a bunch of investments and deals and kind of across the Southeast, but really centered in sort of Tennessee and Alabama. And that gave me a lot of exposure to a ton of acquisitions and deals and operating businesses. And then similar time frame, I also bought in 2011 a really small IT business that was based in Nashville that I ended up doing a couple small bolt-on acquisitions for, kind of running not as a full-time general manager, but really as sort of an operating partner for a number of years. Eventually, we also bought a software company into that IT business. And then in 2017, I kind of fired myself out of the management of that company and brought in a professional management team to really take the business to the next level. We brought in some outside growth capital and I sort of scaled out. And today I'm still an active board member in a number of the Fresh and family companies. But around the same time or a little bit after I left our technology business, I basically set up Eidolon as an investment entity and really set out to go focus on private equity investments. I don't really like that term, but it's sort of the easiest way to describe what we do. But really, a lot of my investing thesis today is informed from probably just reading too much Warren Buffett. And so I went and read years ago, but read all of pretty much everything he's ever written and really deeply drank the Kool-Aid on this whole concept of value investing and buying old school kind of boring businesses that generate cash flow and really focusing on buying great companies, hold them for a long time. You don't have to buy some crazy new AI, crypto, whatever startup. It's like, we're looking for, I'll give you an example of some of the stuff in our portfolio in a second, but we're looking for stuff that's like the most old economy, boring stuff you can think of. So in our current portfolio, I still have that IT business, still the software company. Those are a little kind of cooler, sexier, whatever. But we have a business that manufactures portable sinks and hot water hand washing stations. So really cool little niche company. We have a business that distributes pallet racking and industrial shelving. We've got a company that does light industrial staffing for warehouse workers, forklift drivers, et cetera. Recently exited a medical equipment company and a couple other sort of small investments that we've made. So our portfolio and our thesis today is really around finding unique opportunistic deals that are, again, not really focused on tech or AI or any of that sort of stuff, just looking for boring businesses, sort of old economy companies. And in a lot of cases, those businesses are under optimized and there's a lot of opportunity to improve them and professionalize them and grow them. And strike zone wise, we're typically looking for businesses that are sort of 2 to 5 million of EBITDA, give or take. Southeast based, being based out of Nashville, but that's the portfolio, that's the thesis, and that's kind of what we're up to. And I've been yammering on for a while. I'm happy to tell you as well about the name of Eidolon if we want to go down that rabbit hole, or I'm happy to unpack more about our deal thesis or mergers and acquisitions, why I think it's such a really unique and powerful growth strategy, or whatever, wherever you want to go from here, Chandler, you tell me.
Yeah, man, I love it. I'd love to know the story of Eidolon, though. I need to know I'm a marketing guy, right? So I need to know the brand. Like, where's the spirit? Like, where are we going? Like, give me the story so I can connect people when I'm selling. And I'm like, hey, this is what, you know what I mean? I gotta have it.
I'll give you the story. It's like, it's not as it's kind of nerdy and it's not as exciting as it sounds. But so
how are you guys different than that stereotypical PE company or VC company like that is? Those reputations are either extremely positive, depending on who you ask, or like literally the devil reincarnated on earth. So how do you guys stay away from this side of that scale?
Yeah, I think it's a really intentional approach. And borrowed candidly from Warren Buffett and a lot of his perspective of like, hey, we want to buy good businesses and we want to be long-term oriented. And I also try to have, and certainly not perfect at this by any means, but try to have a more sort of conscious capitalism approach to the deals that we do. So we want to take care of all the stakeholders. We want to pay attention to the customers, the employees, the community, sort of everybody who the business touches to the extent we can, to create a positive impact, right? And so when we look at a deal or a business, we're typically not going to be the company that comes in and is the max high bidder on a super competitive auction, right? That's not what we do. Really, we're looking for businesses where the founder is looking for someone to take care of the company, to create a long-term home. In every deal that I've ever done, the management team has a meaningful equity stake. We've also started rolling out even company-wide profit-sharing plans for the entire employee base at a number of our businesses, and we'll continue to sort of use that as a tool in our toolbox, because I think it's great for not only rewarding the team but also aligning everybody's incentives around growth. A big piece of our approach is, hey, we're not looking to buy a business, slash and burn, and resell it again in 3 years or 5 years or whatever it is. We're really looking to buy a business, make the right long-term decisions. What's best for this company? How can we invest and make really rational bets around where the industry is going, what's the best for the company, not be trying to optimize for an EBITDA calculation or, hey, we need to do this thing because our earnings can be X so that we can sell for Y in 2 years. We're really saying, hey, is this the right thing to do for the business ultimately over, an infinite time horizon? And if we feel like we're making the right long-term investments, my thesis is ultimately that creates more value than being really short-term oriented. And so that's kind of our approach. And some folks really resonate with that. Some folks, just sort of happy to look for max bid and kind of, take the money and run. But we generally want, the founders to stay involved, have some sort of commitment level if possible. We want to kind of take care of the other stakeholders in the business. And so that's sort of our thesis. Again, are we perfect at that? Certainly not. But we try to be a lot more intentional about that than maybe an average investor would be.
Yeah, I love that you said intention there, because I think a lot of times in business, we want to hold people to a black and white standard where it's like, well, you said you do this and then you're not perfect. And like, God forbid you're not perfect. And my thing in life, you and I have been around the block enough now at this point in our careers to be like, nobody's perfect. I mean, really what I want to know is like, we're going to make mistakes, but what was your intention behind the mistake? Was the intention to be malicious, or did you just make a bad call based on the information you had? And like, stuff happens, you know what I mean? And like, that's a huge differentiator between good people to work with in business and people that are just going to crucify you for like, you didn't, the legalism of like, you said you do this, the dogma says that we are going to, crucify you now essentially. And that's awesome that that's that way. But like, let's say you come across a $2 to $5 million EBITDA company, right? That guy has crushed it. Like with the SBA tells us like what 80% of the businesses close in the first 5 years. The majority of small business owners don't have any employees. Like 31 of the 35 million have 0 employees. And then they average like 50K a year in salary or profit or whatever you want to call it. And so like basically the person you're looking at has made it to the 1% of 1%, like the top of the mountain there, right? And they're probably feeling pretty good about themselves, because I know you and I are both Michael Gerber fans, I'm sure, where like he talks about the technician who evolves over time, and like they figured out how to be the business owner, the entrepreneur, and the manager, or hire those people, right? So they've done it. They're doing 2 to 5 million on the bottom line. They're living a great life wherever they are in the southeast part of the U.S. here. Why would they want to go with any investment partner? And even if they did align with you on those values things you're talking about, like what is the win-win situation there? Like how do you create that, or your partners create that when you guys are coming in and getting involved with the business? Like what is the selling pitch there?
Yeah, so there's a couple elements, and it really varies substantially on a deal by deal basis, right? Like every seller's motivation is unique, right? And the particular dynamics of why they want to sell or why they want to bring in a partner or whatever are going to vary, but based on their personal experiences, where they are in their life, like all of those different kinds of things. I would actually say, though, you would be surprised if you go back to the Michael Gerber framework, how many businesses, even at that size, are, the founder, owner, et cetera, is still really squarely in the technician camp, and hasn't built a lot of the, what we would call sort of like professionalized infrastructure, right? Or brought in those resources to professionalize all the bones of the business, right? The accounting and the HR and the IT and the legal and all that stuff. And, you can get pretty far, especially if your industry has really strong economics or some strong growth tailwinds. Like you can go a long way without having some of those systems in place, but ultimately you'll hit sort of a cap or a glass ceiling or whatever. And so there's a couple breakpoints from there, a couple of ways the journey can fork for given founders or owners, right? So some founders also might have, depending on, let's say somebody's a baby boomer, older, they're at a phase of life where their business is 25, 30 years old. It's grown almost entirely from word of mouth and referrals. It's a really great lifestyle business. They make 7 figures a year, or mid to high 6 figures take home personally, whatever the math is, if they have partners, or how much they're reinvesting, all that kind of stuff. But very comfortable living. And why would they go out, massively inconvenience themselves, overhaul the way they've been doing stuff for 20 years, go learn about digital marketing and all of these things, when they could just keep making 700 grand a year or $1 million a year or whatever, and do their thing and have no stress, and it's just easy, and it's the way they've always done it, right? So for that person, if they reach a threshold where they want to sell, a lot of times those businesses are actually super unoptimized, right? I mean, to the extent of, we've bought multiple companies where there was no website, right? You know what I mean? I mean, it's crazy, but it's true. Like, no website, no sales, like we bought a business a couple years ago. Their entire marketing budget was a TV commercial from like 1995 that they were still airing, right? So stuff like that, right? It's just like you would really be blown away by. I mean, that was a 50-plus-year-old business that had been thriving for half a century, right? But also management hadn't made any changes in like half a century, right? I mean, whole business, pen and paper, all that kind of stuff. So you see these things quite a bit, actually. And it really depends on where the founder is in their life cycle, right? Like, some founders, if the business is candidly where they are the most, to put on the Michael Gerber hat, sort of owner oriented, a lot of times have already built out a management team, phased themselves out of management. And in that case, you have the decision to sell is a lot different, right? So it's like, hey, you don't need to sell. If you have a management team running the business for you full time, and you're cashing dividend checks and hanging out in Tahiti or whatever, there's no real impetus. But a lot of folks, if they're still working the business 40 hours a week, 60 hours a week, or the stress of, okay, what happens if we lose this customer, or this, like, I have to have that keeping me awake at night, right? Eventually people reach a threshold where they're like, hey, or a number where they're like, hey, if I can sell this thing and pocket this, and I can have very low stress and have X amount of dollars in the bank, they feel really good about that. So that's kind of one camp. And then the other camp is folks who similarly would be more of like Michael Gerber's technician, that get to a certain threshold and they're like, hey, I know we can do more, but I can't do more with my existing infrastructure, and I don't know how to go to the next step, right? Yeah. And that's where maybe the owner wants to stay involved more so. And we help provide, and this is something I learned a lot on the fresh side of the world too, because we've seen that story play out many times, is we provide the infrastructure and some capital to help it scale. And then you take a really talented technician founder, let them stay in their lane and crush it, and remove all of the barriers, obstacles, they don't want to deal with HR and payroll and accounting and all of that stuff that weighs you down. Get all that stuff off their plate and let them cruise. That's when you can really break through some barriers and create meaningful operational growth. So again, coming back to the question, it's a little different for each sort of founder profile. And those are a couple major ones you'll see, but the reality is everybody's story is different, right? I mean, some people, a lot of transactions will happen because of, I'll probably miss one of these, but they call it the 4 Ds, right? Which is, I can get at least 3 of them. It's like
pressure's
death,
on,
disability, divorce, and then I don't remember the last one. But the idea is, like, a lot of times just natural life events cause businesses to have to transact, right? Again, death, disability, divorce, and then whatever the other D is, we'll figure it out eventually.
Is it disagreement?
Maybe it is. Yeah, maybe it's just like a founder disagreement or something. But the idea is, like, if you look, I mean, you hit the nail on the head, right? It's weird. This morning, I was actually, I have like a weekly newsletter about buying businesses called the Deal Mastery Insider, and it's free. And like, I talk about deals and just the whole M&A ecosystem and case studies and all kinds of stuff. And this morning, I was working on my newsletter for this week, and it's about the silver tsunami, which you hit on, which is this idea that it depends a little bit on what data sets you look at, but it's like there's the data I had was like there's like 32, 33 million privately held businesses in the US. As you said, it's like I think like high 20s of those 20x million, 27 million or 30 million of those are sole proprietorships. So like, one person bands, or what I would call dancing bears, where it's like the bear stops dancing, the money stops coming in. And then the remainder are businesses that actually have employees. Well, so the interesting thing is, again, depends on what data set you look at. I've seen estimates around 40% up to as high as 60% of all businesses in the US are owned by baby boomers. Right. And
Yeah.
so if we just use a midpoint 50% as an easy thing, 30 million businesses or 33 or whatever, call it 15 or 16 million businesses that are baby boomer owned. Right. And I'll do some quick mental math here. If we assume that those businesses need to sell over, let's say, the next 20 years for whatever reason, right? All the 4Ds, death, disability, people want to retire, they want to get out. If we assume that over the next 20 years, we take that 16 million, we divide it out and say, 1/16 of those are going to need to trade every year. And we assume, round numbers, that 20% of those businesses that sell each year will actually be marketable and need to transact, right? So we take 16 million, we divide it by 20, and then we take that number and we take 20% of it. That's about 150,000 businesses a year, even after you whittle it down and divide it by 20, that need to change hands over the next 20 years. And when you look at the math, and again, there's different estimates for this, but the number of average M&A transactions per year for the last 20 years is around 20 to 30,000 deals a year.
Has that ticked up at all in recent history?
It's starting to, right? As the silver tsunami is kind of beginning to manifest. But if you think about that fact, 20 to 30,000 businesses a year historically, and we have 16 million businesses that need to transact. We assume 80% of those close and don't trade. And then that remaining 20% is spread over a 20-year time horizon. It still adds 150,000 a year to that 20 or 30K number, which is like, depending, it's like maybe whatever, almost a 10x increase, an 8x increase in M&A transaction volume over the next 20 years, basically. It'll be lumpy. Obviously, it's not going to be exactly, but that dynamic alone, right? That's not even people saying like, man, I'm really tapped out and I can't grow this business. It's just the natural course of life and the 4Ds. All of those businesses, like at some time horizon, right? Unless we go infinite and enter the singularity, like those baby boomers will eventually reach an age where they have to sell the business and or close it or pass it down to their kids or whatever. But that sort of slow moving steamroller is not going to stop. And so if you think about the motivation for sale, life events are also a huge component of that. And the silver tsunami, which is what the term that everybody uses to talk about this is looming on the horizon, is going to be a crazy transfer of wealth. Like most people think trillions of dollars, up to like 10 trillion is one of the high side estimates I've seen of value/wealth being transferred from the baby boomers to either the next generation or business buyers or whatever over the next 20 years or so. So that's why I'm like grabbing the bucket and getting ready for the deluge. Like I'm trying to be in the position to capitalize on that, and maximize the opportunity set. But also coming back to what we talked about a minute ago, a lot of those businesses just won't have a home, right? It's like you have a great company, your kids want to be a TikTok influencer, and they don't want to take over your business that manufactures mechanical boilers or whatever, right?
Or what you said
And
earlier,
what's going to happen to that company?
One portfolio
right?
company that does the hand washing stations, right? Or the racks for big warehouses. It's like those are unsexy businesses. They're not IT, right?
Yeah, exactly. They're not IT. That's exactly right. But yeah, I mean, like the reality is a lot of those, there's no path forward. The employees aren't really positioned to meaningfully take it over. Sure, some businesses can do an ESOP or whatever, but there's a huge amount of businesses that will need to find a home or close at the end of the day, right? And so you don't have to be if you're just sort of standing in the flow and occasionally catching a deal, I think you're going to be pretty well positioned.
Well, I was going to ask you what you thought. I want to talk about M&A as a growth strategy here in just a second. I've got a great case study for you because it's very selfish. It's my company, and so I'm going to get free advice here with this podcast. Yeah, and but what are your like gut feeling on like that's a lot of movement, both from a wealth and just logistical situation where you have so many businesses changing hands, and we know how difficult it is to operate a business, and we don't have the same youthful, like you said, TikTok's kind of a distracting thing, YouTube, etc. But like also there's just not as much population coming up, right? That's where we have this population bubble at the top with this baby boomer thing. Like what like just quick answer, like, what do you think is going to happen when all those businesses don't transact? Like, is this just going to create a huge hole in the market for young guys like us to come in and fill it? Or like, are we just going to have is that going to be an economic recession? Like, where do you land on that? Because small businesses have a huge impact on our global economy.
Yeah. I don't know. I haven't really thought through what the economic implications are. I mean, I would imagine most going concern businesses that are providing economic value, right? If they're in a niche that's active, let's say it's an HVAC business and somebody, has 5 employees and they've been doing it for 40 years. And now HVAC is another sexy industry right now, believe it or not, where there's a lot of acquisition opportunity and a lot of companies being purchased. But somebody's been doing that and they try to find a buyer. They can't because the business is really a dancing bear that's totally reliant on the seller. And eventually they just kind of shut it down, right? In that scenario, is that going to cause a recession? Probably not. Like if you had, you were using Joe's HVAC for the last 20 years and they're closed, you'll probably just open up the yellow pages and call the next HVAC company, right? So what a savvy either acquirer would do, or maybe even Joe's HVAC would do, is say, hey, instead of closing, what if Joe called, Chandler's HVAC company and said, hey, I'm probably going to close my business in the next 18 to 24 months. Do you want to take over my book of business? You don't have to pay me some massive sum, but if you pay me, a percentage of revenue or some earnout over time based on the customer base and the volume that I will bring to your business, I can have a little bit of an off ramp. I can maybe have a home for my employees and my crew. And when my customer calls my number, it's not going to be doo doo doo. You know what I mean? It's going to be, hey, welcome to Chandler's HVAC. How can we help you today? Right. So those kinds of, I call those business giveaways, and they already happen all the time. Like I bought multiple businesses like that for our existing portfolio companies, where we've found somebody who's basically closing up a small business doing less than $500,000 a year of revenue, and we bolted them on for an earnout over a couple years. And they benefit because instead of just closing, they make some revenue over the next few years. Their customers don't get left in the dark. And if they have any employees or team members, they can kind of come along to the new company. It's such a better outcome. And so if you're a savvy deal maker, and this applies to any industry, but I think especially industries like agencies and others where you have a huge amount of sole proprietors or small business owners, there's just a huge opportunity for this. So I think people who are savvy deal makers that are thinking about it like that can just put the bucket out and, okay, boom, Joe's HVAC's closing, we'll add $500,000 of revenue. Dave's HVAC's closing, that's another $500,000. And then suddenly, instead of those guys just going poof and being gone, and somebody else, looking through the yellow pages or Google or whatever to find the next HVAC vendor, now you're taking over that book of business. So I think I guess it's a really long-winded way of saying I think the market fills a lot of those gaps. But it's really a loss for the business owners at the end of the day of, if there's no exit path for your business because you are the business, then in most cases, and that's why I made an estimate, 80% of those businesses basically just closing. Most of those businesses are just going to close down, right?
Yeah. I have a good example of that. So when my first business was called Lyle's Barbecue Company, we started in a tent on the side of the road. Our first restaurant, brick and mortar, we had no money and we didn't have investors, so we bootstrapped everything. It was a little gas station restaurant that had closed, and we just took over it. But then we outgrew that, and we started looking for the next thing. And so I had this idea of like, oh, hey, maybe there's a restaurant owner around town, and I didn't know what M&A was at the time. I didn't really know that was an option. And I found another barbecue restaurant in a pretty decent area of Lexington, Kentucky, and just happened to strike up a conversation at dinner with the owner one night. And was like, I just floated the idea of like, yeah, we're looking for our second location. If you know of anything, let me know. And I kind of in my mind was like, my gut feeling was like, I bet they would sell to me. But I wanted to keep my brand and bring it in. And so we ended up like a week later, they emailed me and wanted to do a deal. And for like 25 grand, we bought a brand new location. But the real thing was, and this, we took over their lease. So all their personal guarantees and everything came off. And that was where their value really came in. And then we paid for some of the equipment. And now all of a sudden we had a beautiful new restaurant. We went over $1 million in sales. It worked out. They got a big check. They got off the lease. Like they got out of the nightmare of owning a restaurant, which they didn't want to do anymore. So it was a real win-win on both sides, even though financially, like I think we ended up better in that situation, but it was a way to like look at what their situation was. We're like, they probably were going to close in 24 months anyways, just like you're talking about. So it makes a lot of sense. So I stumbled into that. And so I'm trying not to repeat the mistakes of my past. Right. And so like 3 years ago, my buddies, Ben and Austin and I, we started, High Beam Marketing. So we're an agency. we've doubled every year because it's really easy to double every year, Matt, when you're starting from zero. You know that. So like doubling every year, especially next year, is going to be kind of difficult from where we're at now. And like I kind of like the idea of M&A, but let me tell you how our team is set up. I'm the visionary guy. I think in 10-year chunks. I think every new fun, exciting thing is worth trying as long as it doesn't bankrupt us. Like, let's do it. I'm in.
Yep.
They are why they're my business partners. They're the ops guys. They think about, okay, Chandler's got these ideas. How are we going to actually make this work? And so I'm going to have to sell them. So I'm going to use this clip to sell them on why we should look at M&A bolt-on acquisition as a way to grow when organic starts to slow down a little bit. So no pressure on you, but like, why should we consider that as an agency when the temptation is to just like, yeah, just wait on these people to close or whatever. And like, maybe you just like, by the way, the number one way we get business is so many bad agencies in the world. And like 80% of my customers have the same story of like, I hate agencies. I hate marketing. I hate it. And then we just come in and we're like a breath of fresh air. So, and it's worked for us to this point, but I'd like it to work faster. And I think M&A could do it. Like, how's that? Like, help me sell them.
Yeah. So there's a couple different sort of levels of doing this, right? So I think, and I would liken, like, you shouldn't stop doing organic growth to start with, right? So it's like running a race, right? You don't want to run it with one leg tied behind your back. So if you only have one leg, you only have organic growth, or you only have M&A, you're setting yourself up to be less successful. So you want to have both to be able to run as fast as possible. And so having said that, the phase one strategy would just be, I call those deals, you talked about the barbecue example, I talked about another example, like I call those deals business giveaways, right? And so finding business giveaways instead of just organically every now and then, hey, we met Joe and he's closing down his agency, having a programmatic approach to, okay, what if we did one of those a year, right? And what if we did one of those a quarter, right? And so those deals, if structured properly, can basically be done as I mean, again, it's going to vary a little bit by deal, et cetera, but like on average, you can probably structure them as a rev share earnout, right? So we did a deal a couple years ago. We bought a data center, it was doing $400K a year of revenue. We bought it for 10% of revenue for 3 years because the guy was exact same thing, closing it down. We took it over. He made, 40K times 3, made about 120 grand on the deal. We made a bunch of money on the deal. It was like a win-win, right? So those exact same kind of strategy, you can do those as they organically pop up, right? And if you guys, I don't know obviously exactly where you guys are from a number standpoint, but let's just say if you have an agency doing $1 million bucks a year,
we'll do 600 this year. So we did 380 last year, 180 the year before that. So we've roughly doubled every year. We'll probably do a little over $1 million next year if everything pans out the way it's supposed to.
So there are tons of agencies out there that are, roughly sole proprietorships that are doing like 300K or 400K of revenue, right? Somebody's doing a couple hundred grand of revenue. They're making like, 80 to 100K a year as like a lifestyle business, right? That there's a huge amount of folks. I've talked to probably 3 or 4 people like that in the last 6 months that were agency owners. And there's 2 slightly different forks in the road that those kind of people will take. One is somebody who wants to keep going with the business. I would call that an aqua hire, and we can talk about that. It's very similar structure, but the other one would be people who want to get out, right? So I've talked to multiple people in the last 6 months who were agency owners who were doing a couple $100 grand of revenue, who were like, hey, I want to leave the agency world, but I don't want to leave my clients behind. I don't want to leave them high and dry. And I'm doing, $320,000 a year of revenue, right? So those kinds of people, instead of just randomly meeting them in your network, programmatically doing them, if you guys do one of those a year, right? And we'll set aside your organic growth rate for a second, but like we'll just call it 700 today, right? You do one deal for 300K, right? Boom, you're at $1 million, right? Next year you do one more of those, right? And this is literally absorbing. You're not even necessarily absorbing the employee. You're just absorbing their client book, which is maybe 10 or 20 clients, right? We'll talk about cross-selling in a second, but setting that aside, you go from 700K to $1 million, right? So that's almost 50% growth. Then you do another one next year, you go from $1 million to $1.3 million, right? You do another one the next year, you go from $1.3 million to $1.6 million. You do another one the next year, $1.9 million, right? So that's like 4 of those acquisitions over a 4-year period, which is buying a 300K book of business is like about as light of a lift as you can get. You're not going and raising money. You're not taking out a loan. You're not putting your operations at a huge risk. If you buy that book of business and the customers attrit and go away, your rev share decreases that you're paying the seller, but you're not, losing a bunch of money. You basically have a free option to continue fulfilling that book of business. So you guys could get to 2 million in revenue with very little operational lift just by finding one of those a year over the next couple of years, right? Then let's think about, okay, what about cross-selling and upselling, right? So, okay, what if we find a book of business where, and I don't know exactly which sort of service sectors you guys focus the most on, but like if, if you guys are doing, let's say SEO, web dev or whatever, right? And you go buy somebody's book of business who's mostly paid media, right? Okay.
Yeah. Would be
Is
the
there
other
an
way. We do
opportunity
paid
then?
media, so
Yeah.
they'd be
So you sell, okay, it's not going to be a one-to-one, but like maybe you sell 50K worth of SEO web dev stuff to their book of business, right? And you sell another 50K of paid media stuff to your existing client base. Suddenly that 700 plus 300, you added 50K here, 50K here, boom, now we're actually at $1,000,001, right? And then you next deal you do, same thing, you pick up another 50 or 100 grand. Then the next deal you pick up another 50, 100 grand of and those are called revenue synergies, is like the fancy finance word for it. The idea is basically there should be, especially another reason why I think agencies are a great place to do M&A. The services are really cross sellable, right? So like if you're rolling up auto body shops, you buy one in Nashville and you buy one in Lexington and whatever, like you can't really cross sell the Nashville auto body shop customers in Lexington. It doesn't make any sense, right? Now, still reasons to do that as a roll up. But if you buy, if you buy any book of business, and unless it is a perfect, overlay with all of the services you're currently offering, you have an opportunity to come in and cross sell and upsell a whole array of different stuff for every acquisition that you do and every client that you bring in the door, right? And so there's tons of ability to generate upsells, which further add to the value of acquisition. So that's like the V1. If you want a really simple one, just try to be a little more proactive and intentional about finding those kinds of deals. Tons of them exist in the agency world. They don't have to be baby boomers. A lot of folks start an agency or they're at an agency, they're really good at SEO. They're like, I'm going to strike out on my own. They go do it. They get a couple $100 grand worth of revenue. And then they're like, this sucks. I don't like being a business owner. I don't like managing the cash and trying to make payroll and, dealing with taxes and QuickBooks and all this other stuff. And they just want out. Or maybe they just want to go back to a shop, in which case you can do the acqui-hire deal where it's basically like, hey, you're making 80 grand a year and you're pulling your hair out because you're tired of doing this stuff on your own. We've got all that stuff already. Come join us. We'll pay you what you're already making. We'll take over your book of business and we'll give you an incentive if you want to keep growing it as that book of business grows, right? So it's like same or more money, your life is way easier, and your safety and security increases because now you're part of a bigger company, right? So very easy pitch. The next iteration of that would be, all right, let's go bigger, right? Let's be a little more thoughtful about actually doing some real acquisitions. And I'll do a little bit of math here, but I'll try to keep it relatively high level.
Hey, I'll use it with doing. I love doing the back of napkin smoker math. I can't tell you how many more formulas I've done on the side of a stainless steel smoker in my day. So this is my favorite.
Oh, there we go.
Ben Tonak, my business partner, would hate it and never let it fly. But like, I'm here for it. Okay, let's do it, Matt.
I'm a big picture guy like you, so I'm like, yeah, the big picture math works. Like we're good, right? So
this is a dangerous friendship we're creating here. I guess.
Yeah, exactly. So if you look at, we'll fast forward. So 5 years down the road, you guys have done what we just talked about, and you're like, man, let's take this to the next level, right? We really want to actually grow with M&A and not just hoover up some of these business giveaways. And I'll just make up numbers, but let's say you guys are at like, 2.5 million of revenue, and your EBITDA or your profit is like 750 grand a year, right? So I don't know exactly what profit margin that would be, but like 25% margin, 30% margin, something like
20
that,
to
right?
30 is
so,
pretty standard in the agency world.
Yeah. So these are just example numbers, right? But like, so if you're, say you're doing 2-3 million of revenue, 750K of profit. So we can have a debate about like what multiples agencies are valued at and whether this is high or low. But I think a reasonable case multiple for an agency doing around 700 or 750K of EBITDA would be around a 4x. Could be a 3x if they have issues, could be a 5x if they're crushing it, but like we'll say 4 is a midpoint. So round math, 750 of EBITDA times a 4x multiple would be a $3 million enterprise value for the company. So the company's worth $3 million at that point, right? Now, let's say you go find a slightly bigger than before, but not really insurmountable acquisition. You find a company doing 500K of revenue and 200K of profit, right? A 200K profit or 200K EBITDA agency would probably be worth 3x at most, right? Maybe even lower than that, but we'll just say 3x for the sake of this example. So also, we'll set aside how you come up with the 600K, because you could do it creatively. You could get a loan, you could get equity, you could do it all stock, doesn't matter for the sake of this math. You go buy that 200K EBITDA agency for a 3x multiple, which is 2 times 3 is 600K. So you go outlay 600K of stock or cash or a loan or whatever to buy this agency in. So now we've taken this business. It was doing 750. We added 200. So now we're at about 950, right, of EBITDA or profit. And we had a $3 million company that bought a 600K company, right? So let's also say, just for, we have a little bit of, maybe we're paying twice for, HubSpot or Go High Level or whatever, and we had 2 accounting firms, and we consolidated an office, and also we had a little bit of cross-selling. Let's say all of that stuff adds up, and we just nudge it to like $1 million of EBITDA just to make it easy round numbers. So there's this thing called multiple expansion, where basically bigger companies trade at higher multiples, right? So once you cross about $1 million, you typically would see an agency maybe get into the 5x EBITDA range, right? Maybe even higher than that. But for the sake of this example, we'll say 5x. So by taking that $3 million value business and it buying a 600K business, $3.6 million of total enterprise value. Once you get that to about $1 million of EBITDA, which we had 750 plus 2, we're at 950. We make a couple improvements, we get to $1 million. That $1 million EBITDA stream is worth about a 5 times multiple, which would be a $5 million value. So just by combining those 2 companies, making a couple tweaks, we basically take in $3.6 million worth of value, and now it's worth $5 million, right? So again, that's after we account for the 600K being outlaid. So you could go buy that company for 600K, turn around, sell the whole business for 5 million. Whereas if you sold them independently, you'd sell for 3 million and 600K.
Yeah.
That's the concept of multiple expansion. So, or another term for that is multiple arbitrage. So what you could then do is you can basically effectively print money on paper by going out. Now that your company's worth a 5x, you go buy another agency that's worth that's doing 200K at a 3x, right? You spend 600K, which is just 200K times 3. You spend 600. As soon as those 200K of earnings join your P&L, because your company trades at a 5x, that's worth $1 million. So you spend 600, you added $1 million to your company's value. You go spend 600 more, you add another $1 million to the value, right? And so what happens is, as you're doing that, you're also continuing to build your EBITDA. So if you do a couple of those, now you're at 2 million of EBITDA, you might trade for a 6x multiple. And then the value continues to expand upwards. So this is why roll-ups create ridiculous amounts of value, because over time, you're buying companies at a multiple below what your company trades at. So you spend 600K, it instantly creates, if you're at a 5x, 400K of value, because that 600K earning stream is now, or that 200K earning stream is now multiplied by 5. It's now worth $1 million. Yeah. So you spend 600 and you create 400K of value to have $1 million asset. So you go do that a couple of times and then sell it. And then suddenly, even after the fact, if you raise investor capital or take out debt or whatever for those acquisitions, you're still netting up. Or if you trade all stock, right? You just give somebody 600K worth of stock in your business. Day one, the company's worth more because their 200K of earnings is worth more inside of your business than it is as a standalone. So there's a bunch of merger math in there, which maybe was a little complicated, but hopefully that conveys the topic or the concept of why acquisitions, and especially roll-ups, once you get a little bit, on the higher end of the scale too, can really create substantial amounts of value.
Yeah, well, it's kind of, it reminds me of value is not created linearly, it's created exponentially.
Yep.
And just because a pie is a certain size today doesn't mean tomorrow it will only grow by, 5 when it'll be 5x, right? So that is a exponential growth versus just linear growth. It reminds me of, do you know who Marcus Lemonis is from The Prophet?
Yeah, of course, The Prophet, yeah.
Yeah, so we were on that show with the barbecue restaurant, and I went to work for Marcus for a couple months. And
that's awesome.
Yeah, it was great. It was a great experience, great story. But his story with Camping World was the same way, right? Where they start with camping RV dealerships, and they do a massive nationwide roll-up to create the biggest name in RVs, and now Camping World crushes every year. And so it's like, I've seen this play out for HVAC and restaurants and even RVs like that. So it's fascinating how that math ends up compounding over on itself. But it's a little red flag in me, and this could be my business partners coming out. I hear him yelling in the back of my head, like, Chandler, that sounds great. Like, where's the downside? Like, where's the risk in this, Matt? Like, how do you mitigate the risk? So, like, I have a rule now in business. Like, I don't take any risk that if it doesn't go well, we go bankrupt, because I did that once, and it's very painful and not fun. And then the other risk is you don't bankrupt the brand, which is don't be a Nazi on the internet. That's basically all you got to do. So, like, how do you mitigate risk when you're trying to do one deal a year, two deals a year? And like, I guess as it gets better, you go faster, but like those first three or four deals are pretty risky, I would imagine, from a just experience and knowledge base. Like, how are you recommending agencies like us mitigate that risk?
Yeah, so there's a bunch of ways you can mitigate the risk, right? So one, I would say, without like shifting the context too much, like one deal a year is from a programmatic M&A standpoint quite slow, right? I mean, there are case studies of many companies across many industries, including the agency vertical, who do like 15 or 20 acquisitions in like a 3-year period and go from like a million or two of EBITDA to like 40 or 50 and sell for some crazy number, right? So like there are people out there who will go do it on a massive scale. So like part of the way you mitigate the risk in my mind is just taking a slower pace, right? So digesting one acquisition a year should in theory make it more absorbable than doing, like, if you really wanted to push the envelope, even one a quarter is like more ambitious and aggressive than one a year, right? So I think that's part of it. I think another part of it is targeting. There's rough rules of thumb, but like generally you don't want to do an acquisition that's bigger than 30% of your business, right? So even if it blows up, as long as you're not like, and again, if you're doing that on an annual basis, like you have a full year to digest that acquisition before you do another one, you have a pretty good sense of whether it worked, whether it didn't work, that kind of thing. So as long as you're doing it at a sustainable pace, you're doing it in a way where you're not buying companies that are too big. Those are two big risk mitigants. The next one would be just deal structure, right? So we talked about some of those early deals, the business giveaway, acquihire type deals. The risk is other than the opportunity cost of integrating and negotiating and structuring the deal. If you buy a business as a 10% or 20% revenue earnout, if the revenue goes to zero, your earnout payments are zero, right? And so in that scenario, your financial risk is virtually de minimis, right? And that's what you're basically taking something off of somebody's hands and saying, hey, whatever value comes out of this thing, I'll give you a piece of it. But if that value is zero, then I'm giving you zero, right? And so if you just do those sort of really creative deal structures, you're setting yourself up for a much better risk position, right? Now, let's say you go out and you're taking out, like, the riskiest probably would be going out and taking out a loan for every deal, right? So that's probably the most high risk deal structure. But even then, if that was a strategy you wanted to use, which, I think there's pros and cons to doing that, like, you wouldn't necessarily pay all cash at closing. In fact, the vast majority of private business purchases aren't all cash deals, right? Especially for smaller businesses and especially in a service driven, asset light business model like agencies. It's extremely common. The vast majority of transactions have some sort of, what the fancy term for it would be, deferred consideration, i.e., seller notes, earnouts, rolled equity, those kinds of things. And so even if you were like, if you're paying 30% or 40% of deferred consideration, even if you're taking out loans, you're only really going to be taking out a loan for, 50%, 60%, maybe on the high end, 70% of the business's value, which again, loans would be the riskiest way to do it. And then the other way you de-risk it is just doing diligence and ensuring that there's a cultural fit, right? So you want to have third-party firms come in and audit the numbers and pay attention and make sure it's a fit. And you want to make sure you're not jumping into something that's too risky, right? So you mitigate it with structure, you mitigate it with pacing, you mitigate it with size. All of those different things are risk mitigants that you can implement.
All right, Matt, that's awesome. So like I'm going to learn more and, kind of leading the witness here a little bit. I know where this episode's going and I'm excited because in a couple weeks, you and I are going to be together at a event in Nashville called DealCon. And you're actually going to be speaking twice, I believe. So I'd love for you to tell us, like, what is DealCon and how can people learn more?
That's right. Yeah, I'm speaking a couple times and kind of helping put on, though. A partner of mine, Tom Shipley, is really sort of leading the charge on the event, an event in Nashville called DealCon. And so DealCon is September 23rd to the 25th here in Nashville. And it's really focused specifically for agency owners and digital brand e-comm owners about how they can buy businesses and scale their companies using mergers and acquisitions. So it's a 3-day event. We're capping it out probably at about 100 attendees. So it's going to be really intimate. We're bringing an incredible roster of really talented speakers, people who've built 9-figure companies, rolling out the playbook for how to do this on an even more advanced level than some of the stuff we talked about today, and really use M&A as a very powerful growth strategy. Plus giving folks there the Rolodex of all of the people in there, the speakers, et cetera, so that they can take that, go out and execute these strategies really tactically in their businesses day to day. So that's DealCon. You can learn more at dealconlive.com. It's in a couple weeks here in Nashville. Come check it out. Spots are limited. And me and Chandler are both going to be there hanging out. So it's going to be a lot of fun.
It's going to be awesome. We'll link to all that stuff and your LinkedIn as well, because you're one of the best LinkedIn follows I have. Every time I see one of your videos pop up, you do a great job of taking an incredibly complex subject and an emotional subject for a lot of people. A lot of identity is tied up in business and acquisition and selling and all of that. And you find a way to do the Feynman principle, right? Like you explain it like you're explaining it to a fifth grader, but not in an insulting way. And so I just want to commend you on taking a complex subject and making it approachable for us South Georgia barbecue guys. I appreciate that. And we appreciate everybody out there listening. I appreciate you joining me today, Matt. We'll catch you next time. See y'all later.
Awesome. Chandler, thank you so much for having me on the show, and look forward to hanging out in a couple weeks at DealCon.
Yes, sir. It's going to be good.